taking the time to be with us for a very important conversation. We really appreciate it. And I have with me, my name is Pushpendra Mehta, and I have with me Craig Jeffrey, Managing Partner at Strategic Treasurer. Welcome, Craig.
Good to be here, Push, and welcome everyone.
Thank you. We are here to discuss the top action CFOs are taking after the recent banking failures, and what can corporates or corporate treasury do to defend against cyber threats. 3 days after the collapse of Silicon Valley Bank and a day after the closure of Signature Bank, Gartner polled over 250 CFOs to ascertain their responses to recent bank failures and financial sector instability. 85% of CFOs have expressed concern about the impact of bank failures on their current operations, while 18% have noted they had some level of exposure to one of the failing banks. Craig, while finance chiefs and corporate treasury are using the banking sector crisis or chaos as an opportunity to reevaluate internal and external risks, what, according to you, can be done in terms of suggesting two actions that they could adopt to mitigate risk losses?
Well, limiting it to two is pretty restrictive, so I'll try to abide by that for part of the conversation. But some of the Gartner research brought up a couple factors. One was diversification. So when we think about some of the threats from bank failures, diversification is a long-known risk management factor, not just for bank failures, but for investment management, not putting all your eggs in one basket. We see some of the answers there tying into that, a long tradition of diversifying your sources of capital, for one example, to reduce that. Spreading out your deposit base among different banks, or sticking them into maybe government securities where they're not beholden to a $250,000 limit. Those are a couple ways of managing the risks for the bank sector. Mm-hmm. From the cyber, I'll answer from the cyber fraud side as well. One of the key things that people can do is do a payment security assessment. Look at their entire payment process from beginning to end, because that entire chain represents points of exposure and points of weaknesses. We see places like SWIFT, payment card industry, DSS standards, PCI DSS, pushing organizations to review and protect their endpoints. But everyone needs to look at these from an end-to-end basis to reflect the new level of attack that organizations are facing. So those are a couple of them. I certainly have more than I gave you three, but there's certainly more than that.
Well, for the rest, they should come to you for advice. You're a consultant and a leading one. The banking turmoil has also brought two other risks onto the spotlight, which is concentration risk and counterparty risk. Concentration risk may have contributed to the downfall of SVB. Can you suggest a measure or two to prudently manage concentration and counterparty risk?
Well, I'll go back to diversification and understanding your counterparties. I mean, counterparty risk management peaked quite heavily in 2008, 2009 with a number of failures during the financial crisis. That stayed elevated for quite some time, but we haven't heard about it nearly as much until the recent gyrations around some of the bank failures domestically, and the forced marriages that have occurred into some different countries. So most notably Switzerland. As we look at that, this idea of, are you diverse, not only in where your cash is and what your access to credit might be, so having maybe multiple sources is certainly a long tradition. There's also an operational risk. If you have all of your operational activity at a single financial institution, that may be extremely efficient, but it presents some areas of risk. Just like what we see in the supply chain, when you have key components from a single source provider, that can create a significant risk on the rest of your production, because you've single sourced it. It wasn't that long ago when a number of larger organizations would look at 60% of your activity with one key bank, 30% with a second, and 10% with a third, and you had operational activity, and you'd be able to switch and change the volume of activity you had among those different banks that you had. So those are a couple of the items that people can and should look at. How are you diversified? How quick would it be to switch? Because if something goes bad very quickly, you usually don't have a tremendous amount of time. So, and everyone else will be trying to do their own setup and get connected to those institutions. And so our ability to switch quickly is important. I know you have a couple more things to say on that, but when we think about how quickly the switch may need to be, you look at that Thursday when $42 billion was basically wired out of Silicon Valley Bank that afternoon, and it was closed the next day. $42 billion is a significant sum of money, even for the trillion-dollar banks. That's a massive sum. Having to try to cover that, you can see how quickly that occurs. It's not like the bank runs of old where people would line up around the blocks. You can see those pictures from the 1929 where the people would be lined up forever and withdrawing $500 at a pop. But after several weeks of that, the funds are drained. Now it's almost instantaneous where those funds can move, and so something happening on Twitter can create panic or very rapid movement.
You mentioned that $42 billion sparked a classic bank run. And the media also widely reported that Silicon Valley Bank did not have a chief risk officer for the last 8 months of 2022, and the replacement was hired only in January of this year. As a CFO or a corporate treasurer, isn't that a red flag to watch out for when assessing your existing banking partners?
I think it's something worth paying close attention to. I did want to say something about, for all of our friends and people who've worked at Silicon Valley Bank or work closely with those at Silicon Valley Bank, there's a huge human element to this. This is very difficult and trying times, and many people are displaced, and those are very significant issues, particularly if you're directly impacted from it or secondarily. Anytime the C-suite is with an open position for a significant period, especially something like a chief risk officer at a bank, that could or should be some indication. But oftentimes banks have fairly deep benches, so I think it requires some monitoring and calibration. But that's, after the fact, it's certainly elevated and makes the news. We say that without a chief risk officer for a period of time, you could bring up, there's a number of reporting activities that were being done by the San Francisco Fed. Where was the oversight there? I think there's a lot of time to go through and dissect this in some more detail to see what learning can be done from in the future, what learning we can gain from that. But it's certainly a potential indicator, not by itself, but an indicator of a potential issue.
A potential issue. Another potential issue may be the fact that in the wake of the banking collapses, cybersecurity or cybercrime, this may become a fertile ground for cyber criminals. Between March 6th and 12th, 2023, IT security services provider ReliaQuest observed a surge in registered domains, with 95 new domains likely impersonating Silicon Valley Bank. It is said that typo squatting, phishing, and business email compromise attacks are expected to increase in the aftermath of the banking turmoil. What can you suggest one or two ways that can help corporate finance and treasury professionals better recognize fake communications from cyber criminals?
Yeah, I mean that's the typo squatting where people create these. That happens regularly all the time, and most banks subscribe to services that hunt these down and extinguish them. They go through the methods of shutting them down very quickly, and those happen. The shutdown occurs fairly quickly, but the challenge here is the opportunity for the criminals to put these up quickly. In a time of panic, people are less apt to be careful and check where they're going. So what should people do? Your IT group should have some controls put in place for monitoring where you can go with certain computers and what you can do. But for treasury groups, all of your bank connections, you should have a list, a digital list where you can go to their website, not by searching, not by doing a Bing search or Googling the site, but by clicking on a link that you know and trust. from a document that you have. So having those stored, so it's known to go there. A second area, and this is more popular with some of the treasury technology providers, where you might have single sign-on or SAML2, where there's the federation, the authorizations are linked back to the corporate database and registry, so that it prevents that type of activity. That's becoming available at banks. Some banks have that, and that's another potential activity. But certainly something that's standard and would be considered commercially reasonable is to use things like multi-factor authentication. In addition to an ID and a password, having a barcode or an SMS text or other element to make sure that you have confirmation that the person that's doing the transaction is the right person. This is what banks tell their customers, and they see fraud all the time, and so those become standard levels of control. If you don't have that, you're not at a commercially reasonable business process.
Can I ask you a follow-up question in terms of cybersecurity? You run a very successful treasury consulting company that focuses on treasury services and risk management, among other of your offerings. You also run SecureTreasury.com, which is a payment security training company for corporate employees. Can you give, just focusing on the banking collapse and what's going on now, can you give just one or two tips if you had to advise a company, a $1 billion company, or a bank, what would that one measure that you would recommend that employees in particular, in terms of training, that they undertake to arm themselves?
Yeah, I mentioned earlier the payment security assessment, looking at the entire payment process to find where there are gaps in that. And many of the gaps can be compromised through people. And so this idea of the upgrade, putting patches in people's heads, is obviously not digital. It's this ongoing training. The most successful companies are having training, and they're testing on that training, and more they're doing it more frequently than once a year. This once a year cycle tends to be too long. And so this idea of we're continuing to share what people are doing, what criminals are doing, what their playbook is, how they're gaining access, that can help make sure that everyone's alert to the different types of criminal attempts for cyber hacking, penetrating payment systems, spoofing, email compromise. There's just so many of those activities. Those are certainly things people should do on the on the business side and the human side. There's also other areas, the data loss prevention activities and services that exist, the ability to the filters that you use, some of the activities from an email standpoint, DKIM records, for example, all those help provide a more secure communication method when it happens to be done through email to a certain extent. So making sure those are all robust. The people, your communication methods, how you access it. And that was way more than one.
Thank you so much for your generosity and your time. I'm sure it would be of immense value to all the audience who were gracious enough to join us today. A big note of gratitude to them as well for taking out the time to be with us. We very much appreciate it. Thank you, Craig, and have a wonderful week.